Thanks for joining us for the latest episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. In each episode, Michael Merlin, founder of Merlin Wealth Management, along with various experts, breaks down complex financial topics to help you increase your wealth span and gain the confidence to enjoy your bigger future. For more information about Merlin Wealth Management, please visit our website at rocco.com/Merlin. You can also find Michael's book, Financial Longevity, on Amazon, Audible, or wherever books are sold. And with that, here's founder of Merlin Wealth Management, Michael Merlin.
Thanks, Tom, and welcome everyone to another episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. Today, we are exploring how ultra-high net worth families and individuals can grow and protect their wealth through strategic private investments. And I am very fortunate today to have my dear friend, Samantha Cooper, who is the head of alternative investment distribution for Rockefeller Global Family Office, joining us today. Sam will share her deep expertise in all the areas of private investments, private equity, venture capital, real estate, private credit, and we'll be discussing these asset classes and how they can serve as powerful tools for long-term growth, and also talk a little bit about financial preservation. So with that, I am very excited to welcome my friend, Sam Cooper. Hi, Sam.
Hi, Michael. Thank you so much for having me. I'm thrilled to be here.
Thank you for being here. So, I know we always talk about the fact that at Rockefeller, one of the most powerful and unique resources we have is our alternative investments process and platform. So can you talk a little bit about how Rockefeller supports clients in evaluating private investment opportunities, and then also providing due diligence and some unique other aspects and features?
Yes, absolutely. So we have here at Rockefeller an open architecture platform where we, evaluate opportunities across the alternatives landscape for our clients. One of the things we're really, really focused on is providing access to managers that have truly best-in-class track records, and have been in the business for many, many years. In many cases, focused on a specific asset class or a niche sector where they are best in class. We have an extensive due diligence team that work through many, many hours of due diligence with every manager that we evaluate. And so we, first and foremost, are always sort of looking through the lens of a potential investor and asking and learning about every single manager that we evaluate well before it ever gets out to our advisors or our clients. We're constantly thinking about building out a portfolio that really provides our clients with a range of risk return profile type investments, both from a more semi-liquid type structure to something that might be locked up for many years, that may be more appropriate for who's somebody who's willing to take some illiquidity risk for some enhanced return. So if you could, just imagine, we look at hundreds and hundreds of managers a year. We bring to our platform somewhere between 15 to 20 unique managers annually. So we are vetting through a lot of potential opportunities before we bring our clients, those very special, unique ones.
Absolutely. And so talk a little bit more about the factors that you guys look at, because again, I think one of the unique attributes of our platform is that we do bring some unique opportunities onto the platform. We bring some smaller managers, maybe some nichier product offerings. So with the due diligence we're doing in order to kind of provide these to clients, what are some of the key factors that people should know about, before, when they're coming to us and potentially committing to these things? What are the factors that are going into your decision making as far as bringing these things onto the platform?
Yeah, I mean, it's really important for us to see a consistent track record across managers. In many cases, one that spans more than one or two fund vintages. That's not to say that we won't opportunistically partner with a manager who's, maybe a spin-off from a broader platform that's going off on their own and creating something unique and bespoke if we have high conviction in the historical experience of that manager. But really, first and foremost, seeing that a manager can really invest through cycles, right? And making sure that they have experience with the ups and downs of the market is really critical, right? Because we see so much fluctuation in our market today that we really want to make sure we can find and pick the best who have experience investing in all different types of environments, right? And then like really digging in deep to the process that they use to work on their due diligence as they're looking at deals, right? We want to make sure that these managers are really vetting opportunities at a level that we have comfort in, that they have the underlying knowledge that they really need to make investments, right? And so it's two layers deep, right? It's not just the manager, but it's their ability to execute and evaluate investment opportunities. So we really take a very, very deep look into every management team and investment team that we partner with. But so then it's also, we look to really partner with managers who have an institutional client base, knowing that institutional clients who have a very rigorous due diligence process of their own um, have continued to partner and support a manager over many vintages. That's really strong and powerful as well, right? And
Yeah.
in many cases, these managers that we're looking to partner with, they're not looking to just raise AUM and raise assets. So we like to see fund managers who have kind of stuck to their knitting, I would say, right? If they're raising a fund, they're not raising multiples of a fund size every vintage. They're sticking to what they're good at. They're slightly increasing their fund size based on, the environment and the deals that they see. But most of the managers that we partner with really don't even have space in their cap table for more dollars or for more additional LPs. We see a continuous set of LPs that re-up. And really they're looking for Rockefeller as, an additional institutional type LP to sit alongside their institutional investors and really tap into our network of very, very ultra high net worth, sophisticated investors. They're not just looking to raise the next dollar. So all of those things are really important factors as we evaluate opportunities for our clients and really find managers that we feel of the caliber that we want to work with.
I think again that it's such a great advantage to have that level of diligence being done on all of the platform investments that we offer. And I think just taking a step back quickly for our listeners, private investments for us spans multiple things, right? But at its elemental level, right, we talk about private equity and venture capital really as being different ways to invest in equity, right? So if our clients think about equity, venture capital is extremely early on. Private equity is a little more seasoned, but again, those are still ways to invest in equity. Private credit, which is not a new genre, but certainly a very popular one today, is just a different way of investing in fixed income, right? So you're talking about loans versus potentially bonds, but again, a more cash flow oriented opportunity. And for us as advisors, from an asset allocation perspective, it's pretty it's pretty straightforward to see how private equity, venture capital, and private credit can complement the traditional asset classes in a client's portfolio. But what we've seen a lot of more recently, especially in working with in partnering with you, is we've seen some things that kind of go outside of those bands, right? Some unique things, whether they're real estate or other opportunities. So are there some sectors or themes in private markets right now that you guys think are particularly compelling, and especially in some of these less traditional areas?
Yeah, I mean, look, you just hit the nail on the head. I think we have definitely been seeing a lot of interest on the private credit side, right? Senior secured lending has been like the topic du jour. We've seen tons of dollars flowing into the space. I think with that said, we are also cautious with a significant amount of capital flowing into a space. Our clients definitely are attracted to yield oriented type strategies that provide an illiquidity premium to fixed income of sometimes 175 to 200 basis points over a syndicated loan, right? And so we like that exposure, but we're trying to figure out and find ways to diversify from just the senior secured lending private credit. So we've been really very focused on the asset-backed private credit space, finding opportunities that also have attractive yield with structural protection. Typically, something that has assets that are backed as collateral that will ultimately help protect on the downside and provide some diversified exposure. So we're, an asset class that we're looking at is, aerospace. We do a lot on real estate, royalties, right? Things that will provide continuous income and cash flow, but aren't necessarily directly linked to senior secured lending. And then also provide some of that, uncorrelated type exposure too. So you're not seeing the fluctuations when you see the fluctuation in the public market side, as you would with some fixed income.
So I think that's a great lead in into, I don't want people to think, I don't want our listeners to think that the title of this podcast was sort of a hook, because we talked about wealth preservation in addition to investing in private markets. And, I do think, you just talked about some areas where wealth preservation, non-correlation, yield are really the focuses of some of the strategies that we offer. But I do think that sometimes clients get a little bit comfortable with the fact that because private investments in general aren't necessarily priced on a daily basis the same way that public investments are priced, that there's a false sense of security that, oh well, the market's down but I'm not really down, or my wealth has been preserved, or I didn't, the market went down 10%, there was a recession, but my private investments, nothing, those were fine, right? I think we all can sometimes get lulled into a trap because valuations of private investments are not real time, right? So I think it's important for people to understand that if you own private equity, right, or you own any sort of aggressive private investment focused strategy, right, those things are going to be volatile in some way. You just may not see it in the same way you see it kind of just in time when you're watching CNBC or Bloomberg, or looking at your portfolio on online, right? But I do think there are ways to employ private investments to create non-correlation, to create portfolio stability, to create a hedge against beta, right? Which is sort of what you're talking about here. But I think a lot of that also is being thoughtful and intentional about how you allocate to private investments. So what are you guys seeing as far as clients allocating and balancing the illiquidity piece of private investments versus the premium, as you mentioned, that needs to be created, and an ability to maintain liquidity, and also this an element of wealth preservation?
Yeah, I mean, I think this is where Rockefeller really stands out in terms of, advisors like yourself who really work with clients on a daily basis to continue to evolve their portfolio, right, based on their liquidity needs. And I think, this is really more of a dynamic discussion that happens with advisors and clients here at Rockefeller all the time, because I think clients are constantly trying to evaluate their liquidity needs, where they're comfortable with locking up capital. I would say that, as you build out a more diversified portfolio, making sure that you break down, the most appropriate allocations to ensure that you have that immediate short-term liquidity for all of your needs, that are going to happen real time. And then sort of think through, okay, farther out, how much am I comfortable with locking up? Maybe 2 years, maybe 5 years, maybe 7 years, maybe 15 years, right? And each level that you have comfort in locking up longer, and tying up that capital will allow you to create enhanced returns across your portfolio. Like, you do get compensated for illiquidity, right? And so I do think that for ultra high net worth clients, it's important to look at your portfolio holistically. And Michael, you do a great job of that with your clients. We're always talking about this as to how much are we comfortable with locking up to realize that enhanced return in the portfolio, right? And then on top of that, an added benefit of many of the alternatives is to also be able to achieve that uncorrelated type allocation, right? So that piece of your portfolio, you're not necessarily seeing marked on a daily basis, right? You have to have comfort that that allocation is one, locked up, not liquid, but also not going to price like a liquid investment would, right? In many cases, and the challenge with alternatives is sometimes the delay in reporting and the comfort that clients have with that. And there's many times where a quarter ends and you're not getting that quarter end priced until 30 or 60 days after that quarter ends, right? And so that's something that clients do need to get comfortable with as they're looking at evaluating sort of the longer lockup illiquid type opportunities. But again, there are also in many cases the opportunities that create enhanced returns for a portfolio, which is also nice.
Absolutely. I think two things to follow up on with those comments. Number one, the utilization of private investments, especially growth oriented, private equity, venture capital, et cetera, is really, really impactful when it comes to advising clients on their overall wealth planning and their overall estate planning, their wealth transfer plans. Because if we've done our job correctly and our clients have an entity set aside that really is to grow for next generations or for charity or for both, that those are not assets that are being looked at for cash flow, for living expenses, for buying a vacation house or whatever the case may be. Those are really legacy assets. And in the legacy asset bucket, you have license, if you will, to be more aggressive because by definition, that's dynastic money. It's going to last for a long time. And the longer the time horizon, to your point, the easier it is for us to handle the illiquidity, handle the lack of pricing, not necessarily knowing what our investment is worth today or tomorrow, but knowing that the goal is for that to be a 2 or 3 or 4x, 10, 12, 15 years down the road is much more palatable in that scenario. I think the follow-on question though, and you may not have too much to say about this, but one piece of feedback we get a lot and we feel a lot, right, is in that, even if you're in that bucket where liquidity isn't necessary, most of our clients are entrepreneurs, they're business owners, they're family business owners, and it's hard for them to sit back and look at something and not know what its value is, right? So if I'm looking at a price on a private equity deal or a direct investment today, that price could be from December, right? It's August, and we deal with that all the time. And what we try to tell our clients is, look, it's really no different than owning a private business. Like you don't really know what it's worth until you sell it, right? Someone could tell you it's worth $100 million today, but unless someone's willing to write you a check for it, right? You don't really know what it's worth until the end. Do you agree with that? Is that the way that you would also advise people? Because again, I know that there's, we get great reporting, and you guys are awesome about making sure we have timely reporting from whether it's a direct investment or a manager, as far as what things are looking like in a quarter and how the trends are working and how the businesses are performing. But from a valuation standpoint, it's a little more of a guess, of an estimate.
So I would say I'm going to take this back a little bit to what we talked about or what I mentioned earlier. It's really important to partner with top tier managers who are truly experts in a space. And I think, in my history and experience, those top tier managers are the ones who are more conservatively valuating their portfolio with comps. And as such, I would actually agree with you. In some cases, you don't know necessarily all the upside that you could be experiencing based on a quarterly or semi-annual report, because there's a lot of potential upside from there, given the conservative nature of the marks of many of these top tier managers that you don't know until exit.
Right.
I would say, especially in private equity and venture capital, in some cases, there's not direct marks or mark to market numbers that you can use to price some of these, right? And so in many cases, you're looking at the underlying fundamentals of the company and how they're performing, and you're tying some mark to it with an illiquidity premium tied to not a discount tied to it, given the conservative nature of evaluating some of these opportunities, that I think a good manager, there will be a lot of upside at exit,
Yeah,
right? So
absolutely.
that's accurate.
For sure. And I also think that, like you said, I think good managers are smart in that sense because, the business climate can change for a private company very quickly. The business climate can change for a public company very quickly, but because, the price is coming up every 5 minutes, right? When that changes, it's very evident in what happens with the stock price, right? But you can go a quarter without hearing an update on your company, right? And if the economy or their particular sector goes through, a tough time, those dynamics, those fundamentals can change very quickly. And so it'd be worse, right? If the manager was putting some, very highfalutin valuation on a bunch of their positions, only to see, the sector go through trouble, and then all of a sudden have to surprise everyone on the other side and say, well, wait a second, EBITDA was positive last quarter, but now all of a sudden it's not positive anymore, right? So, I like when managers are talking more about valuation methodologies, like, hey, when we get a company to EBITDA positive in our sector, typically it's a 10 times EBITDA or 15 times or 6 times or whatever the number is. That's sort of the number you can slap on and maybe do a discount just based on illiquidity to say, okay, this is probably what it's worth, right? But tracking the company fundamentals seems to be a more linear process. It seems to be a more predictable process.
Yeah, I would agree. I think, where we're seeing more mark to market valuations are in the venture space, to be honest, and companies who are issuing different rounds or continuing to raise capital, right? And
Yeah,
so maybe are in a different situation than like a middle market private equity manager would be, which we were, effectively just referencing. But
sure,
these venture companies where they're going out and raising subsequent rounds at higher valuations, that may be different. You might see the mark to market, increase because they have
sure.
to price it and value it at the round that they're issuing shares at. So you do see a dynamic that differs, based on what segment of private equity that you're focused on and that you're investing in. So there is some difference there to consider as well.
Absolutely. I think that's such a great point. In the earlier stages for businesses, that is the marker. It's almost like it's almost like a comp, right? So, when did you invest in XYZ company? Well, I invested in round A at this valuation. Well, I invested in round B at this valuation. It's pretty cut and dry, but I think again, since part of our goal here is to not only educate people about private investment landscape in general, but also some of the potential pitfalls in the ways we think about how investments are priced, right? Those valuations, those series A, B, C, et cetera, again, those are valuations to help raise money, right?
Yep.
Those aren't exactly putting a thoughtful, pragmatic valuation on the business itself, right? So, in those cases, an investment bank that's going out and raising the funds is going to try to get the highest valuation they possibly can. And so, again, I think from pure, if you're trying to be conservative, putting a little bit of a discount on whatever that is probably very, very prudent. And the other thing, as I said before, with middle market businesses or businesses that are already profitable, a quick change in the cycle to the negative isn't going to hurt the business. It'll hurt the business some, but it's not going to hurt it probably to a fatal level. But in some of these earlier stage companies, that can happen real fast, right? Because you're definitely not cash flow positive in a lot of those companies initially. It's a managing the burn rate of the cash flow for the business for a long time, and it's hard to value businesses that are in that stage of life.
Couldn't agree more. And I think your point around, baking in some illiquidity discount into those rounds as they're issued is even more important given that point that you just made, right? These aren't even necessarily cash
Yeah,
flow positive businesses, right? And so you're
absolutely,
valuing them at
absolutely.
a level that is
Well,
challenging.
and look, you guys have done an unbelievable job, in my opinion, in presenting us with direct investment opportunities, the ability to invest not through a private equity fund, but maybe into a company or a small group of companies. And, every time you guys are really good about making sure everyone's aware, we're investing in this round, which is at this valuation. And we could see the very same company come up again in a different round at a different valuation, right? And so I think people need to be careful about evaluating their timeliness, if you will, just based on what series you're in, because you're so early on in the process, right? As a baseball guy, like you're in like the first three innings, in the you're not in inning seven, eight, or nine. So just because I invested in something and the valuation went up 10%, and then you invested in it, doesn't mean necessarily that I'm at a better place, right? We're it's a very small dot along a very long process, and you're very much at the beginning.
I would completely agree with that, Michael.
Good. So let's pivot for just a second. I thought we would talk next about, we've been talking about sort of what is and what was. Let's talk about what's going to be. Um, what trends are you guys seeing that you think will shape the private investing market, for the future? I know everybody and their brother is talking about AI. So, is AI going to play a role? And what other things do you see shaping the industry going forward?
Yeah, I mean, we've seen such an evolution in alternatives over the last 5 and then even over the last 10 years in terms of just access broadly, right? So I think something that we've seen shape and I think we'll continue to see shape just the alternatives landscape are some of these structures that were implemented and created to allow more clients access to alternatives. And that means these structures that create a little bit more liquidity, so semi-liquid evergreen structures, give investors who have that who can't take that illiquidity or that lockup more comfort, and access to alternatives that have some type of liquidity options tied to them. Now, albeit a lot of those do have caveats and gates and certain structures in place that they're not daily traded, right? And you can't get out like a public company or like a public stock. So I do want to caveat that. But nonetheless, these structures have really made alternatives more accessible to the broader wealth client base, right? And that not only by providing some liquidity, but also providing lower minimums and lower qualification thresholds. So we are seeing more and more people being able to access alternatives in all different, formats. So it could be a super diversified portfolio of underlying alt investments. It could be, span more direct investing, right? But I think these semi-liquid, more registered type vehicles that have been established are really providing broader access, right? So I think first and foremost, that's important to know.
Absolutely. So, when I hear that and think about, things like private equity being democratized to the extent you just described, the first thing that always comes to our minds is dilution of returns, right? Because if more people are able to access the same thing, which means more cash will be raised or more AUM will be raised, chasing the same trade, so to speak, you know, returns have to be diluted. You and I partnered on a sports related deal recently, and that was basically the theme. We were told that sports as an asset class is going to get democratized. It's not just going to be billionaires that own sports teams going forward. And as that democratization broadens, returns in the space will drop dramatically, right? So if that's going to be a side effect of this, wider distribution of alternatives, what do you see the role of alternatives changing over the next decade for, ultra high net worth individuals and family offices?
I mean, yeah, I do, right? I think that more and more ultra high net worth clients are going to just have alternatives as a core staple in their portfolio, right? I
Yeah.
still think we're early in the evolution of that, though, that there are still clients who are contemplating are alternatives right for me, right? And I think fast forward, that's not going to be a question. It's going to
Sure.
be how do I allocate my alternatives allocation, right? And then it goes to your point that you just made, how comfortable does an investor feel with respect to having exposure to something that's more diversified, that maybe does have a lower dispersion of returns or an overall lower return profile versus something that is long-term illiquid with a higher return perspective and very unique or niche, right? And so I think that one, I think alternatives will be a core allocation to portfolios, no doubt, across the board. But then I think it's going to be even more important to be working with a platform like Rockefeller and an advisor like yourself who can really have the conversation of, okay, we know it's a core allocation, but how do we make the most of that allocation, and how do we get it to cater what we want your returns to look like, right? How do we create it so that it does what you need it to do? And so, that like the structures, the products that are being created tied to these structures are more niche. Managers are focused on specific sectors. So to your point, yeah, you, diversification and democratization across alts allows for something that could create a return that's not as high or differentiated if it's super diversified, and maybe you're not getting that uniqueness that you should in alternatives, but there's ways to get it, right? And then you take a diversified portfolio and you focus on an asset class, right, or a specific sector, and you then start to chip away to create something that's more unique, versus one of the broader, open alternatives funds, that's more diversified, that may not have the type of return that you're looking for.
Interesting. So if I'm hearing you correctly, what I'm thinking is that, our clients have a core allocation in traditional asset classes, cash, fixed income, equities. So they would have that. Then there would be a similar style, almost standardized alternatives allocation, which would maybe be more of these semi-liquid structures for the traditional types, maybe for private equity, private credit, maybe real estate, etc. And then the real alpha generation is going to come from the unique opportunities that we talked about. Obviously, we specialize in, but potentially more of the directs, more of the, more esoteric strategies, or things that aren't exactly, within the traditional bounds. You mentioned royalties, or some of the other kind of non-traditional areas we've played in. So I guess potentially the traditional elements of alts will be, more standardized, and that you're really going to get your additional alpha from more unique ideas.
Yeah, and I see it every day, right? I see these unique ideas becoming more and more interesting to our clients, because I think your concern that you mentioned is absolutely real. When you start creating structures that are super diversified, you start, blending down returns, right? And so, yes, you can have exposure to that in a portfolio, which we're all comfortable with at some level, but it's how do you create those outsized returns now? And that evolves, right, over
Sure.
time. And I think every client, and this is how, one of the things that I think Rockefeller really stands out, and advisors like yourself who continue to, have those dynamic conversations with clients around evolving and shaping portfolios. It's how do you like make sure that you have the right allocation to those very diversified funds, but then maybe for that longer term bucket, continue to tweak what the portfolio looks like from a longer term illiquid type, allocation. Because maybe as the, diversified piece of alts continues to become more and more diversified, you want to reduce your exposure there and increase exposure to some of the unique, structures that maybe provide some outsized returns, right? So it's really going to be a constantly evolving, I think, allocation to a client's portfolio as alternatives continues to grow, and these new products continue to be developed.
Absolutely. So do you think that, it's funny, like I remember when Citibank and Travelers merged at the beginning of my career, and everyone talked about the financial supermarket, and everyone was going to go to a one-stop shop. And I just remember thinking that, on that, like, as that was the direction everyone was going, boutiques and customization were going to become very valuable, right? All the people who wanted the opposite, it was going to become more unique, more valuable, harder to get. So now that we're sitting here talking about democratization and semi-liquidity, et cetera, I'm guessing that in circumstances where illiquidity is required, right, the value and the premium for that is going to have to be even richer, for people to want to participate in those things going forward. You know, so if I was looking for an uber amount of alpha, I might seek out an illiquid opportunity, because I may be able to get even more of a premium than I had previously when these new structures are available for, that provide, semi liquidity.
I mean, absolutely. Here's an example: the private credit space, right? Private credit has evolved to be almost at the forefront of creating these evergreen vehicles with some semi-liquid type structure, right? And you get an uber diversified, portfolio of senior secured loans. Um, that return profile should look very different from a drawdown private credit fund that has a 5-year investment period and
Yeah,
7-year
totally.
fund term. And that's one of the things that we're constantly evaluating as we're looking at opportunities for the platform. Are clients getting compensated for illiquidity? And as sort of these semi-liquid structures have emerged, you're exactly right. That illiquidity premium is now more expensive, meaning it needs to be higher and the returns need to be bigger and better than what we're seeing in the semi-liquid space, right? So there's a comp, and managers know this, right? And I do think we're seeing, and I'll pick on the private credit space, we're seeing managers really make sure that the deals that they're structuring are, and for the less liquid type funds, are creating outsized returns. So they do have a higher coupon or a higher pick, and they are structuring terms that are at a premium to what the broader commingled funds evergreen structures are.
So interesting. I think, as you said, the character and makeup of our stable of funds, our platform going forward, could look very different, when you start to differentiate between. And again, I guess, you guys will figure out, and maybe you have a few final thoughts for everyone on this particular topic, which is, I guess, from what I'm hearing you say, it's a balancing act, right, between uh, participating in something that maybe has some liquidity as part of it, giving you a little bit more peace of mind that you can, get money out in incremental ways, versus finding something where uh, illiquidity premium or alpha maximization, or having that be your primary goal, would be separate, right? And so, balancing between a private credit fund that doesn't offer liquidity, or doesn't offer as much liquidity as another, right? How do you decide sort of which to put on the platform, or do you put both? And how do you envision that working, in the future?
Yeah, I mean, that's something we're really focused on, is making sure that we have a diverse set of offerings for our clients, right? And so I would tell you, we're trying to figure out both, right? And we are constantly in search of the right illiquid private credit manager. And the right means good track record, has invested through various cycles, and provides returns that significantly outperform something that our clients can get in a semi-liquid structure,
Sure.
right? And so, and we're picking on private credit a little bit here, but one of the things that we're constantly looking at is just, again, across the board, best in class managers across asset classes. So it's not just that we're super focused on private credit because we like the yield component. We have a diverse set of managers that we're working with across private equity, venture capital, real estate, infrastructure, where we truly partner with institutional managers who aren't looking to become sort of the next biggest from an AUM perspective, but are looking to stay the best, and partner with elite institutional clients. They see Rockefeller as an institutional client on their cap table, and therefore we can find these partnerships, build these partnerships, and then allow our clients access to them. And so I think, we're looking across the spectrum of risk return profile offerings for our clients, from the semi-liquid to those direct deals. And I think, Rockefeller and the power of the brand, we've really been able to build out a very strong platform of offerings for our clients that allow them access to the gamut, right, of alternatives.
Absolutely. Well, Sam, I can't thank you enough for taking the time and sharing your insights, and really helping us understand this evolving landscape of private investments. I think the future sounds super interesting, and obviously the uniqueness, the due diligence, and the care and attention that our team takes to creating a differentiated platform is going to be even that much more important to our clients going forward. And so, for our listeners, I'll kind of leave you with this. Obviously, the things that Sam talked about as private investment, as the private investment landscape evolves, are very important to keep in mind. But we also talked about, wealth preservation. And wealth preservation isn't necessarily just about avoiding losses, but it's about making smart, forward-looking decisions, that align with your values, that align with your goals, that align with, a typical strategy or priority you might have for a particular section of your asset allocation. And so it reminded me of a quote from Benjamin Franklin that says that an investment in knowledge pays the best interest. And so I think in this particular case, especially when it comes to private investments, whether you're evaluating private equity, venture capital, real estate, the main thing is to be fully informed and intentional with your decision making. I think, as Sam mentioned, our platform is very accessible. We're doing a lot of high quality diligence, as she talked about. And again, as advisors, that's our job as well, to make sure that we're making very informed, thoughtful, and intentional decisions across the board, but particularly in cases where our clients are giving up liquidity. So until next time, thank you for listening to Financial Longevity, and we'll look out for you on the next episode. Thanks so much.
Thanks for listening to this episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. To learn more about Merlin Wealth Management, visit our website at rocco.com/Merlin. This material was prepared by Rockefeller Capital Management. The views expressed of the host and guests in this episode are as of a particular point in time and are subject to change without notice. The views expressed by the speakers are solely their own and may differ from or conflict with those of other divisions in Rockefeller Capital Management. This information was provided for illustrative and educational purposes only. From time to time, we may mention specific securities or investment strategies where we have an active position on behalf of ourselves and or our clients. Any mentions of a specific security or company is purely casual and should not be construed as an investment recommendation, investment advice, an offer of Rockefeller investment advisory or brokerage services, or a projection or illustration of the performance of any particular investment or strategy offered by Rockefeller. Investing involves risk, including the potential loss of principal. Before making any investment decisions, listeners should conduct their own research and consult with a qualified financial advisor to ensure that any investment is appropriate for their individual circumstances. Forward-looking statements, including those presented herein, are inherently uncertain, as future events may differ materially from those reflected, and past performance is not a guarantee of future performance.